Hey everyone, welcome back to my channel, Malone Money Mindset. This video is actually a request from one of my viewers, Will at Camper Life. He has an amazing channel. He's also an amazing supporter. So I really enjoy his content because I'm an outdoorsman myself. I actually went to school in upstate New York. And when I had the opportunity to go to a campsite that was actually ran by our campus, so it was like really roughing it for the weekend. Me and my friends went a couple times throughout our time in college, and it was legit like no power, no running water. We just had a big campfire in the inside that kind of gave us all the heat. Middle of the winter, was really cold, but we just had a blast. We did a little canoeing, and also over the summer, one of my best friends, his family has a RV. We'll take it out to the beach and we'll just kind of spend the weekend there. Go in the water and make a campfire at night. So I really enjoy watching his content. So that being said, if anyone's interested in that kind of content, please feel free to check out his channel. That being said, he's been asking me to do a stock analysis review on the stock called DOMO, D-O-M-O. So I really wanted to do that video for him because he is, as I mentioned, a really great supporter. And if anyone is interested in me doing a similar video to this, if there's a stock that's in my portfolio or a stock that you're interested in, you would like me to do a similar kind of video, similar kind of analysis, please let me know down below. I'd be more than happy to. I got to mention that these next few months is going to be busy season for me. So I'm going to be typically working a minimum of 55 hours a week in excess of me, sometimes even 70 hours. So it's going to be a little bit hard, but if I can find the time to do that video, I will. But if not, I'll definitely, push that back a little bit and get that out, a little bit after busy season. So in this video, I want to touch a couple of different areas. So the first one is I want to do an overview of the stock, just an understanding of the core business. I think that's a really important aspect of investing, understanding the business that you are investing in. So if anyone is following me along with my investments, you know I mainly focus on just blue chip stocks. So when I'm investing in those stocks, say Apple, Disney, Budweiser, like most people understand, a little bit about their core business and how they operate. Of course, there's a lot more that goes into it, a lot of different segments, but for the most part, you have a good understanding of those companies. When it comes to a company like this, I have to be completely honest with you. When I heard him say DOMO, I've really never heard of the company before. So I wanted to make sure that I had an understanding of the company and of their core business. So that's the number one thing I want to touch. The second part I want to touch is competition. I want to go over some competition because I think it's important to understand who you're competing with and kind of what kind of market share you're working with. So that's number two. Number three, I typically would try to dive into financial ratios. But with this company, they're actually not profitable. So some of the big, most important ratios I would like to look at are typically price to earnings, EPS. And if you don't have any, positive earnings, your EPS, your PE ratio is going to be zero because you can't, get a multiple on earnings if you have, negative earnings. And then again, you're going to have a negative EPS. So that's really not, very useful. And it's also, they don't provide a dividend yield. So that's another thing I would look at. So those three are really not very relevant for this stock. So the next thing I would like to look at, and I'm going to go into in this video, is financial statement analysis. So I think a really important part of this company and this industry is definitely top line revenue. So I want to look into some financial statement analysis of this company with their, their revenue, as well as compare that to another company that's kind of one of their competitors. So that being said, I want to jump right into this video. This is the first part of the analysis. We're going to provide an overview of the stock DOMO. So DOMO is focused in the tech industry, and they are a cloud-based computing company. So their cloud-based service provides, real-time data to businesses. So they're able to, pull in multiple sources of data, which includes but is not limited to spreadsheets, databases, social media. So they kind of integrate all that information into an easy to use system, and they provide that information in the means of it. They can even access this information from your cell phone. So this is information that is super useful to companies because you're able to get an understanding of how your company is operating, where are your sales coming from, what demographic of your sales. Just it gives you a full overview of how you're performing, where are your strengths, where are your weaknesses, and it gives companies a better understanding of their company. And some of their biggest customers are actually National Geographic, Fox Sports, Goodwill, which is an organization, and then lastly, eBay. So those are some really big companies, and there are a handful of other ones that I haven't mentioned, but they are continuing to expand and grow out there, their customer base. But overall, I think today's day and age where data is so important, you need to really understand your data and be able to analyze that data and kind of apply that and how to improve your company. So I think, today it's so important. I think providing the service is definitely, something that most businesses will, ultimately have or already have. So that being said, where this is a very important service, there also is, competition out there that already provides similar service as well as cloud-based computing service. So right at the top of the bat, one of the biggest companies is Amazon. So Amazon has AWS, their cloud-based computing service. But I don't think Amazon is a really good representation for a stock to compare, because that's just a segment of their company. It's not really their core business. The next company that is definitely a competitor is Microsoft. They also have a focus on cloud-based computing, but again, it's not their core business. It's kind of a segment of their overall business. The next stock that I think is definitely one of the biggest competitors and probably one of the best stocks to use as a comparison, as a benchmark to DOMO, is Salesforce. So Salesforce is strictly a cloud-based computing company and really focuses on the data, the analytics, and helping businesses kind of improve their whole overall structure and understanding their numbers, their CRM, their customer relationships, and kind of being able to apply that information and data and kind of improve their company. So I think Salesforce is a really great stock to kind of compare the two. So I kind of made a spreadsheet. I pulled in their financial numbers from their income statements, and I kind of did some of my own breakdown analysis. So I'm going to jump right into that right now. Hey everyone, so this is a spreadsheet that I made from information I took off of Yahoo Finance for DOMO and Salesforce. So I took information from their financial statement, from their income statements, and I'm going to jump into a little bit of what kind of information is here. And then later I'm going to go into the analysis that I have provided with some of my breakdown here. So right here from the top line of the income statement, we have revenue and we have cost of sales, which makes up, the direct labor, their raw materials, all into one, all their costs that are associated with their sales. Then if you take the difference between your revenue and your cost of the sales, you arrive at gross profit. This is a kind of analysis I'm going to jump into in a little bit. Then some of their expenses that go into, calculating your operating income or operating loss are research and development and SG&A, which is sales, general, and administrative costs. So right here, you can see that DOMO is operating at a loss. So these are all in red because they are negative and operating at a loss. And now I kind of want to, it's the same thing for Salesforce. But now I kind of want to analyze some of these numbers right here. So if we're going to look at, two companies, their financial statements from, 2017, 2018, 2019, what we're really looking for is kind of the trend and, see, comparative analysis between, multiple years. So we're looking at, from 2017 to 2018 and 2018 to 2019. So revenue growth from 2017 to 2018 was really, really good for DOMO. They were at a 45.59% increase in revenue, which is outstanding. And then in 2018 to 2019, they still had a really, really nice increase. Overall, they went up 31.27%. So a little bit down from the 2017 to 2018 jump, but still over 30% is still really, really phenomenal for revenue growth. And then we're going to kind of look at cost of sales. So cost of sales, you kind of expect that where your revenue goes up, that your cost of sales is kind of almost a 1-to-1 ratio, maybe a little bit less. But you can see that they had a little bit less at a 0.77 ratio between the two. So their cost of sales only increased 35.32% for an increase of 45.59% increase in revenue. So that's actually really good. And then even next year, it got even better. It only increased by 10.32%. That's a 0.33 ratio. So that's actually phenomenal. So if you think about if they're able to kind of translate the same amount of revenue growth and kind of keep that ratio in line with that cost of sales to their revenue, it would have been phenomenal for their gross profit for sure. But overall, gross profit increased at a really nice rate as well. From 2017 to 2018, increased 53.84%, which is outstanding. And then a little bit less from 2018 to 2019 at 46.07%. So really, really good year. So it's important to look at their numbers. But then I think if we go over here and we kind of compare them to one of their competitors, that's just Salesforce, we'll get an even better understanding. But before I kind of look even into Salesforce, I want to kind of understand, and explain the differences between the two companies. So DOMO has only been around since 2010, and they actually went public in 2018. Salesforce has been around since 1999. They went public in 2004. So they're a little bit, they're a much larger company, and they've been around for a little bit longer as well. So 2017 and 2018, 2019 numbers. So you can see that their revenue is a lot larger than DOMO, but when you're doing like a comparative analysis, it's more about the percent changes than the numbers itself. So that's why it's able to, compare two companies and everything's relative because you're looking at the percent changes. So overall, if we look at DOMO right here, Salesforce actually outperformed Domo for both years as an increase in their revenue growth. So they had from 2017 to 2018, it was 24.88% increase, and then from 2018 to 2019, it was a 26.7.4 increase. So Domo outperformed them on both of those revenue increases. As well, look at this. So remember I was saying before about how cost of sales and revenue are usually almost a 1-to-1 ratio. This is basically almost 1-to-1, a 0.97 and a 0.91. For a 24.8% increase in revenue, they had a 24.15% increase in cost of sales. So that's kind of crazy how Domo was able to have their revenue increase, and then they had their cost of sales actually increase at a lower rate. So that's really impressive how they're able to kind of keep those costs in line. The gross profit was not as a substantial increase as with Domo. And I think it's really important to understand this as well. I was doing some research and looking into Salesforce. So there was actually an article that came out in 2014 where they were kind of in a similar situation where Domo is now. They're operating at a loss. They weren't, providing any sort of, positive of returns on their operating income as well as their net income, their lower bottom line. But they were focusing on that top line growth. They were focusing on, revenue. And they were increasing at a 30% clip over year after year. And at that point, they were still unprofitable. And then, fast forward 5 years, and now they're as we see, they're operating at a positive. They have operating income in the green. So that's kind of interesting to kind of compare the two when they were kind of in the infancy stage a little bit, and kind of Domo's in that similar stage where they're kind of focusing on that top line growth where they're not profitable, they're not creating any operating income. So right here we're kind of going to jump more into the expenses overall. So you can see that R&D and SG&A are two of the largest expenses, two of the ones that go into operating income. And overall, like you can see that right here, I kind of did a little bit more of an analysis on a year-to-year basis for Domo. So their R&D increased from 2017 to 2018 by 2.75%, and then it actually decreased by 3.22% from 2018 to 2019. So it's something that you can kind of expect to say a little bit in that range. It's definitely a core part of their business because cloud-based. You definitely need to do a significant amount of research to continue to improve and develop your software and technology. SG&A, sales, general, administrative costs, is definitely a huge part of this company because it's just so competitive. You're definitely going to have to increase your sales and marketing costs for sure. So that actually increased by 8.4% from 2017 to 2018, and it basically stayed the same from 18 and 19. So it was a 0.08% increase. So right here you can see it's just a allocation between the two expenses, the R&D and the SG&A. So a significant portion of their cost is made up of SG&A, 67% and then 68%. So that's because, like I mentioned before, that they have to really compete with other companies in the cloud-based computing segment to really stand out and kind of get a part of that market share. So that is kind of what is worrisome about this stock, is the fact that they do have to spend so much on that R&D, and as well as big part of it is the SG&A. So that is why it's kind of a little bit of a struggle to really build out that market share and kind of get these numbers lower, and also you got to improve that top line as well. So there's a lot of moving parts that goes into these numbers, and it's kind of interesting to see where they will be. But to get an idea on when could be a projection for when they will start to provide some operating income, I actually made a little bit of an analysis down here. Again, this is based on some of their numbers that were provided from 2018, 2019, 2017. I took an average of these numbers and kind of projected it out to see where could they possibly start providing operating income. So again, this is really not that great of a representation because if I'm taking an average and say 2020 they increased their revenue by 50% or 10%, it's just to get an idea, kind of get an understanding of when it could possibly start to turn that profit. So just going to break down a little bit of what I did here and then kind of analyze it as well. So I pulled in all the 2019 numbers from the top for revenue, cost of sales, gross profits, just the difference, R&D, and then SG&A. And then what I did is I applied a rate of the average of the revenue, the cost of sales, R&D, and SG&A from these numbers. So I applied a 35% growth rate for revenue. I applied a 22.5% cost of sales, increase, and then I increased R&D by 2% and SG&A by 4.5%. So again, these are just rough estimates. Again, they could be much higher, they could be much lower. But again, no one has a crystal ball, and they really can't project out what they're going to look like. Of course, the company's going to have a better understanding. But for my stock analysis, I kind of just want to do my own kind of thoughts and my own kind of analysis and kind of see where these numbers would end up. So if we kind of project these out, what it looks like is by 2023 they will start turning a positive operating income. They'll start to operating at a positive with some positive income. So I think that's pretty reasonable in this 2022 or 2023 range. Because if you're looking about it right here, like 2017, you're at a negative 182.86. I mean. And then they're chipping away, but it's still like really far off from being at a positive operating income. So I think this is a decent representation of where it could be. And if you kind of compare that to Salesforce, 2014, you're talking about they're operating at a loss, and now you kind of fast forward 5 years, 6 years, and look where they're at now. They're starting to start to pull in some operating income and actually operate at a positive return. So I think it's kind of a fair projection that in this range they will start to provide some positive operating income. But again, like I said, it's kind of just. It's a projection. It could go either way. Revenue could start to stall a little bit. It could even increase even higher. They can get there sooner. So it's really just for me to just kind of give a little bit of my own analysis on this. But now I kind of want to jump out of this and do a full, little bit of a breakdown of my overview on the stock and just in general of what I think, is it a stock that should be invested in or whatnot. So right now I'm going to jump out and kind of jump into that sort of analysis. Lastly, I want to provide an overview on the stock. So overall, I do like the stock. I think it provides, a nice opportunity as a growth stock. I do like the whole industry of cloud-based computing. I think, right now it's definitely a hot industry, and it's going to be around for the foreseeable future because data is just such an important part of business today. And I think they're doing a phenomenal job with their financials. Their revenue growth has been increasing at a nice rate. I think, overall, when you get into a company that is struggling a little bit, when they have, negative earnings, you kind of can create a nice opportunity. Because if we look back, they actually IPO'd in 2018 at a price of $22. The all-time high of this stock is a little bit over $40. And as I'm filming this video on January 7th, Tuesday, they closed at $22.65. So they're like right near that IPO price, which always creates a little bit of an opportunity to kind of get in at what could be potentially a nice price. But overall, this video is really not for me to say, hey, go out and buy this stock. This is a stock to buy. It's more of me just kind of providing my analysis on the stock and my overall thoughts. Again, I'm not a financial advisor by any means. I'm not, giving you, financial advice. It's just me showing how I kind of analyze stocks, and hopefully this kind of helps, other investors when they go about analyzing stocks. Maybe you start to add in a little bit of a financial statement analysis into your overall analysis of the stock. So that's kind of what this video was designed to do. But overall, I do like, the future of this stock, and it's one that I'm going to be looking into, a little bit more for the future potentially. But a quick shout out. I hope you enjoyed this video, but more importantly, I hope everyone enjoyed this video. I hope you learned something from this video. And if you did, please guys hit that like button and consider subscribing to the channel if you aren't already. Again, thanks for watching, and feel free to mention any stocks that you would like me to do an update on in the future with sort of similar analysis. So thanks again for watching. Hope everyone enjoys the rest of their day. Thanks. Bye.